Hi everyone, and welcome back to our lecture in financial risk management. We've started our discussion of financial derivatives. We've talked a little bit about options, and today I want to go into more detail with respect to futures and forwards as very, very simple, unconditional derivatives. And okay, see the slides. And we want to come up with a price, a fair price, an arbitrage-free price for a forward contract. Same goes for a future contract. Just a quick reminder, what is a forward, what is a future contract? A forward contract is an agreement in which you agree to buy or sell a certain underlying for a fixed price, and you agree to this in a contract, and it is not an option. You have to deliver the underlying and the other side has to pay up, or you have to do cash settlement. So you have to compare the spot and the agreed forward price and then pay the difference. A forward is an OTC contract, meaning that it is a contract that is agreed upon between two counterparties who could be anyone. Any two partners, any two market participants can enter an OTC contract. A future contract, in contrast, is the exchange-traded version of a forward contract. It's standardized, it's traded not on a stock exchange, obviously, but it's traded on a so-called futures exchange. And yes, the future contract, so basically, is a forward contract only as a standardized version that is traded on an exchange. So when it comes to pricing, a forward and a future are actually very, very similar. They're basically the same. So we'll have a look at a forward contract. The settlement date of the forward is capital T. The underlying value in small t equal to capital T is KT. The K is still reminiscent of times when the slides in the lecture were in German, so K actually stands for Kasse, the German word for spot. Small s is the contract date. KS is the underlying spot price in T equal to S. And FS is the agreed settlement price. So that's actually the price you've agreed upon in this forward contract, that FS is going to be paid in capital T, but it has been agreed upon in small s. So this is the notation. A forward, again a definition, when you buy a forward at time S with settlement date capital T, which is a long position, the buyer agrees, and this is an unconditional derivative, it's not an option. When you buy the forward and when you sell the forward contract, everyone has to fulfill this agreement. You don't have any option to, for example, let it expire. The buyer agrees to purchase or settle the agreed number of underlyings at the agreed forward price Fs at maturity capital T. And in some cases, the buyer must provide a collateral, a margin. Why? Imagine that, for example, you want to buy 1 ton of steel, and the current steel price is here, 100. And you agree to buy the ton of steel in 1 year for a price of 110. Because you think, okay, well, it's going to increase, the price is going to increase, but you want to make sure that you're still delivered a ton of steel for a reasonably acceptable price. So 100 is the current spot price, 110 is the forward price. What happens if, for example, the price develops like this? 10. Then obviously, you have to buy the ton of steel for 110. You could have bought it on the market at the spot price of 10. So actually, you are making a loss of 100. 100 minus 100. If you don't have a ton of steel, and if you need it, in this forward contract, you're making a loss of 100 euros. Let's say it's in euros. Now, if you buy this, say, in 100 million, and this is 100, or actually 1 million of these forward contracts, you would make 100 million euros loss. As you can see, at some point you can already see, well, this is going bad. This is going down the drain, and even at this point you can see, okay, I am making a huge loss in this forward contract. So what sometimes business partners will require, that if you're piling up hypothetical losses, if you're piling up book losses in this forward contract, your counterparty will say, well, can you even pay up at the end of the maturity of the contract? And in German we say, Vertrauen ist gut, Kontrolle ist besser. It's the same here. It is okay if you say, well, yes, of course I can pay up at the end, but it's better to be sure and to make sure that you don't have a counterparty that defaults. So at these points, you will require your counterparty to pay, let's say, 10 million, 50 million euros into a margin account. A margin account is a safe deposit where one of the counterparties puts money in, and this is only kept safe for the case that one or the other party piles up such a huge loss that it's facing bankruptcy, that it's facing default. So this is a margin payment. This is used as collateral. Ich erkläre das kurz auf Deutsch. Bei einem OTC-Geschäft, also bei einem Over-the-Counter-Geschäft, wo Sie keine Börse haben, die ein solches Geschäft absichert, kann es natürlich sein, dass, weil es ja letztlich die Zahlung am Ende steht, aber Sie haben sich ja schon vorher vertraglich darauf festgelegt, dass Sie zwischenzeitlich, das eine Seite ist Nullsummenspiel, so ein Derivat immer, 1 Euro Gewinn heißt 1 Euro Verlust bei der anderen Seite, dass letztlich hier Sie mit Ihrem Vertrag so hohe Verluste schon angehäuft haben, dass da eigentlich klar ist, dass die eine Seite richtig zahlen muss. Und bevor Sie das Risiko eingehen, dass dann hier in dem Moment am Ende des Vertrages die andere Seite einfach sagt, oh ja, also ich müsste jetzt 100 Millionen zahlen, ich bin aber leider bankrott, tschüss, ich bin raus. Um das zu verhindern, sagt man häufig bei solchen OTC-Geschäften, dass wenn bestimmte Schwellen überschritten werden, dass dann Sicherungszahlungen geleistet werden müssen, schon in der Zwischenzeit auf dem Treuhandkonto, um sicher gehen zu können, dass am Ende es keinen Totalverlust gibt. Ja, wenn Sie nämlich sehen, ich habe hier schon eine Marginzahlung von 50 Millionen geleistet, die ist sicher irgendwo hinterlegt und der Vertrag läuft dann hier aus und die andere Seite kann doch nicht zahlen, dann haben Sie immerhin 50 Millionen aus dem Vertrag geholt und haben nicht 0 erhalten. Okay, so that's a margin payment, and the account obviously is called a margin account in which you have to pay the money. We will now look at the profit-loss position of the forward buyer in the case of physical settlement or cash settlement. So at maturity, capital T, the forward buyer receives the underlying, the ton of steel, at the previously agreed upon price FS. Conversely, he or she can sell the underlying directly on the market at the current spot price K, capital T. So, as we've seen here, the profit or loss is the difference between FS, this was our forward price, and this is the final spot price, K, capital T. So the difference between FS and KT, or the other way around, that's actually your profit or your loss. Actually, you can see, actually, this is for the seller. Okay. Now, since the spot price in capital T has to equal the forward price for a contract that matures immediately, because F capital T has to equal K capital T, in the case of cash settlement, the buyer receives the difference KT minus FS, or in case of cash settlement, you have to pay the difference. Thus, the profit-loss position corresponds to that of the physical delivery, and it's the same. For the short position in a forward contract, it's exactly the opposite way. It's exactly the opposite. Why? Because a forward contract, just like a future contract, is a zero-sum game. If you earn €1, your counterparty, your contract partner, loses €1. There's no money to be made in this sense on aggregate from a derivative contract. Now the profit loss position is exactly the reverse profit loss of the long position, and it looks like this. By the way, you can see how this is a linear contract. If you have an increase in the spot price, the value, the profit and loss position of your derivative is a linear function of your spot price. So if the spot price goes up €1, your profit also goes up €1, or in case of a short position, the other way around. Now, futures are slightly different in the sense that you do not agree upon a forward price in one single contract, but you can always observe the futures price on the exchange. So T is again the settlement date, S is the contract date, KT is the underlying spot price in time T, and FT, which previously was the forward price, this is agreed price of the futures based on 1 unit of the underlying, but FT is always observable on the futures exchange. That's the traded price of a futures contract. So what's the difference? At time S, the settlement price is not negotiated freely, but it corresponds to the current futures price on the futures exchange on the market. If we now take the futures price and subtract from the futures price the spot price, we get what we call the basis. That's BT, the basis. We also have the following for futures. The futures price for a contract that matures immediately is the current spot price by definition. Thus, the basis at maturity has to be 0. That is, the value of the futures price and the current price of the underlying must correspond at settlement T, and this results in the so-called convergence of the futures price, meaning that if this is, where's my cursor? Okay, here. If this is, for example, the futures price, and this is the spot price, it could look like this. At some point, it will converge to the spot price. And a futures contract, long, concluded at time S, implies the following payments every day. We have to take a look at what profit or what loss the futures contract has piled up. And on every day, and this is, for example, 1, 2, 3 until T minus S, every day you can compare the difference between the current futures price and the futures price on the previous day. And this is the change in your position, the daily profit and loss. And what is now different with, in comparison to forward contracts, on a futures exchange, you will have a daily marking to market. A daily mark to market, meaning what? That every day the exchange will look at your futures contract. It will see what was the profit or loss compared to yesterday, and the newest daily profit or loss will be accounted for on your margin account. And at some point, if you don't have enough money in your margin account, you will get what we call a margin call. That is, the futures exchange will say, dear market participant, dear trader, you've run out of money on your margin account. Please pay additional money into your margin account. Otherwise, we will close your account and we will sell off your futures contract and we will close your position. Bei den Futures ist es so, dass Sie dort nicht die Margenzahlung frei verhandeln können oder sagen können, jeden Monat wird mal geschaut. Bei Futures ist es so, die Börse schaut sich jeden Tag an, zu welchem Preis haben Sie denn den Futures gekauft? Was war der Futures-Preis gestern? Was ist er heute? Und die Differenz, also der tägliche Gewinn oder Verlust, der wird Ihrem Margin-Konto gut geschrieben. Das ist das Daily Marking to Market, also das tägliche, nicht markieren, sondern das tägliche Anpassen an Marktbedingungen, das tägliche Anpassen an Marktpreise. Und wenn Sie dann auf Ihrem Margin-Konto kein Geld mehr haben, dann gibt es den sogenannten Margin Call. Das heißt, Sie werden dazu aufgefordert, deswegen Call, Sie werden aufgefordert, weitere Margins, weitere Sicherungszahlungen einzuzahlen, ansonsten wird Ihr Konto geschlossen. Now the following then applies to the margin account. The total profit or loss until in the time of maturity is the final spot price minus the initial futures price for which you have bought the futures contract. The profit loss position of a forward and futures at maturity are equal, and if credit balances on the margin account, if they earn interest, we have a slightly different situation compared to the forward. With the forward contract, we can neglect any interest rate effects. But here, we cannot, at least if we have an interest rate that is non-zero. So let's assume that a constant debit and credit interest rate of I applies on each trading day. That is, on every day, you have a margin marking to market on your margin account, and all payments on your balance on your margin account bears interest at I%. Thus, every day you also have an interest payment. If you have a negative balance on your margin account, you have to pay interest on your loan. And if you have a positive balance, you get a small interest rate on your margin payments. For the long position of a future, we now have the following. The total profit or loss is the sum of all differences from day to day between the futures prices, and all these payments bear interest. So at the end, all these payments need to be multiplied by 1 plus I. So that's the difference between a forward and a futures contract. Another difference is that a futures contract can also be prematurely settled. You don't have to wait until maturity, but you can simply sell off your futures contract because it's traded on an exchange. And if you settle a long future in small t, if we neglect the interest rate effects, the profit or loss is simply the current futures price, FT capital T, minus the futures price for which you have bought the future. So FS capital T. That's the profit in small t. Same here at settlement. You can see now you have to look at the futures price S, and this is the futures price in capital T. If you take interest rate into this formula, it gets slightly more complicated, but the only difference is that you now have a compounding effect here at the very end. Now, how can you value? How can you price a future and a forward contract? So we'll do this for a forward contract. We neglect the interest rate effects and the daily marking to market, but everything else is the same for forwards and future contracts. So if you remember that, yes, you would still have to include interest rate effects, everything that now follows is actually the same for a forward or a future contract. Now, in the following, we have a valuation concept that is called the so-called cost of carry approach. The cost of carry approach is very simple because it assumes that you replicate the cash flow from the forward contract by doing a very simple strategy: buy the commodity, buy the underlying now, and let it sit around until maturity, and then you have the same cash flow in capital T at maturity. So if you have the same future cash flows, everything, both two strategies should have the same price in the present. So FT is the fair price of a future on a unit of the underlying. KT again is the spot rate, and we simply summarize all interest payments we would get for one monetary unit of invested or raised capital. We would simply summarize this as RT capital T. So this is the accumulated interest. Ich erkläre das kurz auf Deutsch. Wir rechnen jetzt einfach alle aufgelaufenen Zinsen in dieser Variablen RT groß T zusammen. Es ist uns jetzt an der Stelle völlig egal, wie die Zinsen berechnet werden, wie oft wir da Zinseszinsen bekommen. Wir sagen einfach, RT groß T ist der Block, das ist der große Topf, in den schmeißen wir jetzt alle Zinsen und Zinseszinsen rein, den wir jetzt hier in dem Fall für eine Einheit bekommen würden. Wir müssen natürlich mit K oder mit T oder mit F oder wo auch immer mit multiplizieren würden, dann würden wir dann zum Beispiel hier KT mal R bekommen. Und das sind die Accumulated Interest Payments für eine Geldeinheit. Let's now compare the two following strategies. The first one is we buy the underlying using a future or a forward contract, and we get at settlement the profit or loss spot price minus forward price, spot price minus future price. The second strategy is we buy the underlying directly using a loan, same settlement, and we take up a loan of KS, which is the current spot price, and we need to take up a loan of KS to have enough capital to buy 1 unit of the underlying. We let it sit around, and then at maturity, we still own the underlying. We can sell it at the new spot price, K capital T. And what is our profit or loss? Well, we get as a payment the spot price, KT, and we still have to pay back the loan. The loan is this. We've taken up KS as a loan, and we have to pay interest on that loan over the maturity of the contract. So 1 plus R is all of the interest payment that has piled up. So this is the profit or loss from the second strategy, in which we simply buy the underlying now and let it sit around until capital T. Now, if both investments have the same payout in the future, obviously for arbitrage reasons, which we call a cash and carry arbitrage, both strategies need to have the same price in the present, need to have the same price now. So this means simply equate KT minus F equal to KT minus KS times 1 plus the accumulated interest. So KT minus F equals KT minus KS times 1 plus the accumulated interest. And this is very simple. This is gone, minus, minus. So as you can see, the cost of carry price of a futures contract, and if we now say, okay, let's say at any point, not just now in S, let's say KT, the cost of carry price of a futures contract at any point in time equals the spot price times 1 plus the accumulated interest. In other words, if you want to buy 1 ton of steel, let's go back to our example here, actually a long time ago. If we want to buy 1 ton of steel in 1 year, we can buy it now for 100, take up a loan, and if we have to pay 10% interest, then obviously we would say, well, it should at a maximum cost 110. So 110 is the cost of carry, arbitrage-free price of the future. If, however, assume that the price is 105, the forward price, then we can buy it for 100. We can buy the future. And let me just see. Obviously, you can construct an arbitrage from this. Let me just think about this. Yes, you short sell 1 ton of steel. You get 100 now. You put it on a bank account. You get 10% interest. So you have 110 here. And you go short in the future, meaning that you have to deliver a ton of steel for 105. So you get 110 minus 105, and you have a risk-free profit of 5. So obviously, as you can see here, with an interest rate of 10%, the cost of carry, arbitrage-free price, should be spot price times 1 plus R. Accumulated interest with interest and compounded interest. That's the cost of carry price. So actually a future, a forward, when it comes to valuation, when it comes to pricing, is very, very simple. We don't need any sophisticated derivative pricing model. Actually, the cost of carry price for a future is just 1 plus R. It's spot price times 1 plus R. Very, very simple. And as you can imagine, a future and a forward contract thus is also not a very complicated derivative. So if we transform this a little bit, if we say F minus KT, future price, forward price minus the spot price, this equals KT times the accumulated interest, not 1 plus, but only R, and the basis then is the cost of carry. So the difference between the forward and the spot price is equal to the cost of carry, meaning what? This is the cost you have if you need to carry along the underlying into the future. Imagine that you have 1 ton of steel. You buy it now, you let it sit around, and in some models, if you really have physical settlement, you need to account for all the costs of carry. And this is not just interest, it is also transportation, logistics, some place where you can actually store it, put it in storage. That's why it's not cost of interest, it's cost of carry, because when you have physical settlement, it's not just interest, it's also storage, transportation, etc. Sie können hier ganz schön sehen, woher der Name eigentlich Cost of Carry kommt. Die Alternativstrategie ist ja letztlich, Sie kaufen das Commodity, meistens sind es Commodities, zum Beispiel eine Tonne Stahl, machen wir es noch extremer, 1 Tonne Schweinehälften oder 1 Tonne Schweineschmalz. Dann müssen Sie das finanzieren, haben Zinskosten. Sie müssen es transportieren. Das muss aus einer Lagerhalle in Rotterdam, muss das zu Ihnen kommen. Dann müssen Sie es in eine Kühlhalle packen. Dann müssen Sie es lagern. Deswegen also die Kosten, die Sie haben, um letztlich dieses Commodity, das Underlying, bis in die Zukunft mitzuschleppen, wo Sie ansonsten ja dann erst später den Future- oder Forward-Kontrakt dann wo der dann entsprechend dann durchgeführt würde. Das sind alles Kosten und das sind Cost of Carry. Und damit sehen Sie ganz schön, Sie haben 2 Strategien. Kaufen Sie einen Forward oder einen Future oder kaufen Sie das Underlying jetzt und lassen Sie das irgendwie liegen. Und dann, wenn das natürlich in der Zukunft die gleichen Zahlungsströme verursacht, muss es heute den gleichen Preis haben. Und das ist der Cost of Carry Price für einen Future und einen Forward. Now, the assumed interest rate structure can be modeled as maturity dependent, maturity independent. As you can see, you can also use a constant interest rate, etc., etc. This is, I guess, not so much important. It only wants to show you that you need to be a little bit careful how to operationalize this accumulated interest, R. You know, it could be a continuous interest rate, could be a discrete interest rate, and so on. Now, in the following, we assume a cost of carry price of the future equal to the spot price times 1 plus R, compounded over the remaining term of the future, capital T minus small t. Then let's determine the variance and the standard deviation of the future's price. So just use this and calculate the variance of this, or the standard deviation. Now, the standard deviation of the futures price is the standard deviation of KT times 1 plus R compounded of the remaining term. And this is 1 plus R, the compounding factor, times the standard deviation or the volatility of the spot price. And thus, if T goes to capital T, if we're getting closer to maturity, this becomes 1. And as you can see, the volatility of the futures price closes in on the volatility of the spot price. So in the end, the closer we get to maturity, the more the futures volatility will look like the volatility of the spot price. We can also do this for the correlation. Actually, the correlation between the spot and the futures price is, calculate this, it's 1. There is a perfect linear positive correlation between the spot and the futures price. It's perfectly correlated. Now, the last result shows, at least theoretically, that spot and futures prices are perfectly positively correlated. In reality, however, this does not hold. Regularly, we will see correlations that are less than 1. And this is called basis risk. If the spot and the future rates are not perfectly positively linearly correlated, we face a so-called basis risk. And the theoretical basis is called the carry basis, and the empirical one is called the value basis. So this, in a plot, you can see the spot price here, and the theoretical and the actual futures price. We have the convergence of the futures price to the spot price at maturity here. And this is what happens. Now, at the end of our discussion of the cost of carry price of futures, let's consider an underlying which guarantees a guaranteed payment Z. For example, a dividend. We can also include a dividend in this model. It simply means that the capital that needs to be raised to determine the cost of carry price is higher or lower. Actually, here we can see if we get paid a dividend in between, we don't need as high a loan. We don't need such a high loan volume, so we can reduce Ks by Z, and this is what happens. Ks minus Z times 1 plus R, Ks equals 1 plus R, and so on. And the amount to be borrowed must be reduced by the terminal value of the dividend payment Z. If we have more dividend payment, it looks like this, and in the end, the futures contract is simply given by KT, the cost of carry price we've seen before, KT times 1 plus accumulated interest, minus the terminal value of the dividend payments. We don't need that. Okay. So this is our discussion of the valuation of a future and a forward. Next, we also need swap contracts. Swap contracts are contracts in which we exchange a fixed for a variable payment. And for obvious reasons, this is most common in so-called interest rate swaps, where we have a fixed income from a fixed interest rate and we exchange it for a variable interest rate. An interest rate swap thus includes the exchange of, in general, fixed and variable interest payments on a nominal value, the principal amount, for example, 100 million, between two contracting parties, and the underlying legal transactions, for example, two loans or bond investments from which those payments are taken, they are not exchanged. So we're not exchanging loans, we are simply exchanging payments regardless of the question from which contracts these payments originated from. And the payment balance is usually settled on the settlement dates. Now, for the purposes of valuing pricing an interest rate swap, let's consider the transaction as an exchange of two interest securities. So we distinguish the following types: fixed floating interest rate swap. Fixed floating interest rate swap, the fixed interest rates are exchanged for variable interest payments. In a basis rate interest rate swap, we have variable for variable. Variable is exchanged for variable, a different variable interest rate. And the name here refers to the basis rate as the difference between two different variable interest rates. There are also different types of interest rate swaps. For example, amortizing swap, forward swap, extendable, callable, puttable swap, etc. I think the most interesting version of a swap is a swaption. This is an option on a swap contract in the future. So you have the right, but not the obligation to enter a swap contract if you like. Now, in a fixed floating interest rate swap, the so-called fixed rate payer pays fixed interest payments for variable interest rates from the floating rate payer. And this is called the seller or the receiver of the swap. Now, these terms, payer and receiver, they always refer to the side of the fixed interest payments. There might be differences between fixed floating interest rate swaps with regard to the financing of those interest payments. For example, in the case of a liability swap, both parties are granted a loan and they exchange the resulting interest payments they have to make. Conversely, both contracting parties can also generate their interest payments from receivables. This is then called an asset swap. And if we have a mixture, one side generates the payment from an asset, the other one from a liability, we have a so-called asset liability swap. So this is a fixed floating interest rate swap, the main structure. The fixed rate payer A, the floating rate payer B. We have fixed from A to B, variable from B to A, sometimes also with an intermediary, but this is the most simple, the simplest version here, fixed for floating. Okay. Now in a liability swap, actually both A and B are they have a liability against the Gläubiger here, the creditor, and A and B have received capital. They have to pay a variable interest paid or a fixed interest paid, and they now exchange their obligations. So that's a liability swap. That's an asset swap. They've given out a loan, they've given out capital, they get fixed and a variable payment, and they are now swapping it with A and B. And thus, we also can have an asset liability swap. A receives a fixed payment from an asset, and B has to pay a fixed payment and now receives the fixed payment and pays the fixed and receives fixed payment from A and pays a variable payment to A. Okay. Now, how can we price such a swap? Actually, quite simply. Interest rate swaps can be valued comparatively easy simply by comparing the cash flows from the two so-called legs, the fixed rate payer and the floating rate payer leg. The fixed rate payer is actually a money market investment, long, plus a fixed interest investment, short. Conversely, the floating rate payer is a money market investment, short, plus a fixed interest investment, long. And thus, the valuation is very, very simple. You simply need to use a floating rate note and a fixed income product, money market investment, fixed interest investment. And by stripping the variable and fixed payments from these interest-bearing products, you can replicate the cash flows for the two legs of the swap contract. So, some market conventions on swap contracts. Usually, the reference interest rate relevant at a settlement date is the same that was already valid at the previous settlement date. The valid reference interest rate is thus always set one interest period in advance. Then, because this is an interest-bearing product, you need to be sure when to pay how much interest on how many days in a month. So you need the day count conventions, for example, actual 360, 30, 360, 30, 365, meaning that you simply hypothetically assume that each month has 30 days and the year has 360 days and so on. So these are day count conventions. Some other market conventions on swap contracts. Now regarding the quotation or the pricing of an interest rate swap, we usually have the convention that pricing is done inclusive and including all charges. And on the fixed reference interest rate, we have a so-called spread, a markup that is added, and the combined fixed interest rate. So reference interest rate plus a premium is called the swap rate. That's the swap rate, the variable interest rate, no, actually the fixed interest rate, on which the two parties have agreed upon. Those effective swap rates, they are actually also announced publicly by many banks and investment banks, and they vary over time. And we also have bid and ask rates that exist for these swap rates, meaning that a financial institution, investment bank, will enter a swap transaction as a fixed rate payer at the bid rate and as the floating rate payer at the ask rate. So again, bid-ask quotes will reflect liquidity in this segment of the capital market. Okay, that's a plain vanilla interest rate swap. Fixed for variable interest rate swap. Reference interest rate is the 6-month Euribor, Libor. Nominal value is not subject to changes, so you enter the swap contract, let's say for a notional of 10 million. The agreed fixed interest payments correspond to the market level in the form of a market interest rate for the maturity of the swap. And there are no settlement payments at the beginning, at the end of the swap contract. So you're choosing the swap rate in such a way so that no side has to pay a huge amount of money to the other side simply because the prices don't match. These contracts are, I would say, purely used for hedging in risk management. So why use a lot of capital? Simply choose and adjust the swap rate in such a way that the price of one leg equals the price of the other leg at settlement, no, not at settlement, but at the time the contract is concluded. And thus, as a result, everyone only has the hedging effect. Okay. Okay. Now, the valuation of an interest rate swap is usually done via a separate valuation of the fixed and floating legs of the swap. That is, the two cash flows on the side of the payer or receiver. We've already seen this on this slide here. Money market investment plus fixed interest investment and vice versa for the other side. Again, it's a zero-sum game. Every euro one side earns, the other side has to lose. So each of the two legs represent elementary interest rate payments, bonds, floaters, floating rate notes that can be valued comparatively easy. And together with the information on the settlement payments, the present values of the legs can then be compared with each other to determine the fair swap price. Okay, you can also say, okay, let's use a different swap rate, but then you have a payment that needs to be made before you start the contract to equalize the value of the two legs. So in the end, if you take a long payer swap, it's pretty simply the price of a floating rate note minus the price of a fixed income product of a bond, of a coupon bond. Why? Let's make this, let's make a small numerical example. So you want to buy a floater. So you have a floater and the floating rate note, let's say you pay a price 1, P1, and you have the floater, so you get variable, 100, variable, variable plus 100. Now, you go short in the bond, meaning that you get plus the price 2, and you now get the coupon plus 100. Well, not quite. You are investing short. So it's minus F, and minus 100. But in sum, you can see this is actually P2 minus P1. And the cash flow from this combined, from these portfolios, you get variable, you pay fixed, you get variable, you pay fixed, you get variable, you pay fixed, and plus 100 minus 100 is 0. So actually this here, let's use marker, this definitely is the payout profile of the swap contract, meaning the difference in P2 and P1, this needs to be the price of the swap contract. So valuation for an interest rate swap is very simple. You only need corresponding fixed income interest-bearing products on the market, a floating rate note and a bond, and you're done. Okay. Any questions until this point? I will stop the recording for a second, get something to drink, and if you have any questions concerning forwards and futures, we can answer your questions right now and then continue with the Black-Scholes Merton model.